Hey, Market Chameleons. Thanks for joining us on YouTube. We're about to launch a webinar. You ready, D?
Yep. Let's
All right,
go. Hi,
here we go.
everyone.
I'm starting the broadcast now. We're just on YouTube right now.
Okay.
All right. The broadcast has started. Hey, everyone. Thanks for joining us on tonight's webinar. What is an option with Dimitri Pargamonic?
Hey, everyone. Good evening. Thanks for joining us. And before we get started, do you want to just put the disclaimer up really quickly?
Yeah, I love the disclaimer. Hold on.
All right. Thanks. And really quickly, everyone, just so you know, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do or giving you advice. We're just sharing ideas. If you need advice from a professional, then go seek out an investment advisor or call your broker. They should be able to help you answer your questions. So there's the disclaimer. Everyone,
awesome.
Back up. So
yeah, before we get started, let's go through a couple things. Listen, we have a chat. If you're in Zoom for the webinar, which a lot of people are, put the question in the Q&A or the chat. I'll get them to Dimitri as we go through the show, or we'll just open it up to Q&A at the end. On YouTube, we have a bunch of people who are on the YouTube live stream. Just put in this chat and I'll try to get everything over to Dimitri. Thanks for joining us, everyone. And with that, let's get it going, D.
All right, thanks, everyone. And I'm going to try to explain a put option. The last webinar, we talked about what a call option is, gave some examples, drew an analogy. Now, understanding a call option, it's hard enough. Explaining a put option, it's even a little bit more difficult. And I think this is going to be the first time I'm going to try to explain a put option to people. So I was thinking about it and trying to, besides just giving you the regular definition, we'll go over it, kind of paint an analogy of where you may have seen similar situations where you used it in actual practice, and then you kind of be able to get a picture of how it actually works in the stock market. So having said that, I'm going to share my screen, and I'm going to jump to, here we go. So I just did like a little slider. So we're going to talk about a put option, what it is. And then I'm going to go over a few concepts that you have to understand about put options, such as strike, time, decay, a couple other things. And here's you probably, if you looked it up, what a put option is, you saw that definition. It gives the buyer the right to sell the stock, and the seller has the obligation to take that stock or buy that stock if that option is exercised. But we'll get more into that. Before we do, let's just kind of take an example. And by the way, how many people out there have traded put options? Maybe we should ask if anybody's even traded, or like, is everybody?
Yeah, why don't you in chat let us know if you've traded put options? I did ask the question in YouTube Live. We had a couple responses. Yes, one interesting one was a gentleman from India has traded many put options.
Okay, awesome.
Markets. We have coming in on Zoom 1, 2, 3, 4, 5, 6, 7 yeses, 8 yeses, awesome, and 2 no's. There you go.
All right. So this is going to be really quickly. I'm going to give the basics, explain what it is. But if you guys have questions, no problem. Ask me the questions. We'll try to go over it. And I'm going to try to go through the basics kind of quickly and give examples. So let's pretend, like, put all that aside, trading put options, if you never traded put options on a stock, and let's just conceptualize what that is. And let's say you have a car, right? And you get a special type of insurance for the car for total loss. So if something happens to your car, and like in this example, let's say your car is worth $25,000, right? And you bought it, and of course you want to get, let's say you want to get catastrophic insurance, and you want to say that if something happens to this car, and I'm not talking about like dents or anything, but let's just say if something happens to this car where it's a total loss, the car lost too much value because I, got crushed, hit, whatever, I'm going to give it to the insurance company, and they're going to pay me, and they're just going to give me money for the car. So this is what you typically see. You'll say you insure for a year, right? So the insurance has some kind of a term on it, 1 year. You pay a premium for that, right? So it costs you to insure it. Let's say it's like $2,000 for a year. And let's say this is what your insurance will cover, that they will give you in the case of a total loss, you lose, they're going to pay you out $20,000. Okay, that's what they're going to pay you out, 20,000 bucks. So let's take a look why that's similar to a put option, right? And in this example, this is what your market value is right now, 25,000 bucks. That's the car. Let's say all of a sudden, you know, God forbid, but you know, nothing happens. But like, let's say it does. Your car, there's a total loss. It gets hit, and you know, you're not going to be able to fix it for 1,000, 2,000 bucks. You know, it's going to be too much to fix. You call your insurance. You say, I got total loss. They give you $20,000. You could go do what you want with the $20,000. They take the car. So whatever the car, maybe it's worth $5,000 to them, $3,000 or zero. You know, maybe they sell it for scrap. You get 20,000. They get the car. You exercised your put option. In other words, you exercised your right to sell that car to them for 20,000. They, under the contract, had the obligation to buy it from you for $20,000. That's how a put option works. It's very similar. Okay, one person has the right to sell, the other person has the obligation, you know, based on the terms that you agreed on. So a couple things here. How do we compare that to the options? So we see here that $20,000, that's kind of your strike price. In an option, we call it a strike price. Like, what is the price you could sell your stock to somebody? Well, we refer to that as a strike price. In insurance, like, you have this, you know, like, what will they give you in case of a total loss? It's $20,000, right? They're not going to give you $1 million. They'll spell it out. They're going to give you $20,000 and take the car. That's kind of what we would refer to as a strike price in a put option. What else do we have? Term, right? 1 year. 1 year. After 1 year, that contract or your insurance expires, right? After a year, you have to buy more insurance. But if you, after 1 year, if you wreck your car 1 year and 1 day later, and you don't have insurance, too bad. That's it. That insurance expired. And we refer to that as expiration dates in option contracts. And I'm going to go to an options chain and show you how that is. But keep that in mind. You have an expiration, just like you do with your insurance. You have a strike price, like I just showed you here. This price you could sell your stock at, you know, so if your stock goes down, goes below your strike, you have the right to sell it. Even if the stock is below, that's, you know, obviously you don't want to sell it if the stock's above it, but if that stock is below, you have the right to sell it to the person you bought that put option from. The premium, that $2,000, well, that's what it cost you to buy that insurance or to buy that put. In our case, the seller receives that premium, right, as compensation for taking that risk. So they're taking a risk. They're going to receive some kind of compensation, which they think it's worth it to them. Okay, so now, why would somebody sell you the premium like an insurance company? Well, for them, they think it's a good statistical risk. And what do I mean by that? Let's say, based on their model, right? Based on their model, they think that one out of 15 people will actually exercise. This will happen, a catastrophic event, 1 out of 15 people, and they're going to end up paying out $20,000, right? So if they sell, and let's see if anybody figures it out, how much can they profit on average? If they sell 15 insurance at $2,000, right? How much are they bringing in on average, right? They'll probably do it hundreds of times, but on average, you sell 15, you're bringing in 30,000, correct? 2,000, 15 apiece. Yep. You think one of those you'll pay out? That's 20,000 going out, right? 30,000 coming in. That's what they think their average profit is. So statistically, that's what they're doing. Does that make sense to everybody? A I'm doing it very simplistic.
So why don't we Zoom, let us know in the chat, and also YouTube, let us know in the chat. Do you understand what Dima is saying so far?
Because that's what they're doing. It's a probability. It's a probability bet. Obviously, they don't know in the next year if somebody's going to get into it. There's no way of knowing. But what they do is keep a historical database, calculate their statistics, and say, for $2,000, this is worth it to me. Next year might change. You know, on average, 2 people get into an accident, they're going to raise the premiums. So that's how they compete. But that's what's going on. Same thing is going on in the marketplace. Why would somebody sell a put option? Well, they're going to collect premium if they think it's a statistically good price. You know, they're going to take a look at it and say, this is a good price, because statistically, if I do this across the board many times, on average, I'm going to collect more premium than I'm paying out. Okay. So a lot of, you know, probabilities go into play when people are trading options here. Now, another thing is, what do you guys think would happen is day one, you get this insurance, right? And you pay $2,000. So now you have insurance for 1 year, and you paid somebody $2,000, and now you guys have a contract. Well, let's say 6 months go by and nothing happened, right? So now you have only 6 months left, right? So half of the term is up. And let's say that insurance company says, you know what, we want to take this risk off the book. We see other opportunities. We want to move our money around. And they go and sell it to a reinsurer, right? So now you have this policy, 6 months left, same terms, they'll pay you out $20,000, you know, but they want to sell it to somebody else. So the obligation will go to somebody else. Or do you think that premium, did it stay the same, go up, or go down? So now you're insuring somebody for 6 months instead of 1 year. Would that premium, what do you guys think? Stay the same? Still selling it for $2,000, selling it for more or less? Or what are people saying?
What do you guys think? Deem is asking the question. Any guesses out there?
Well, think of it this way.
Most of them are, some are saying go up, some are saying decreasing.
Okay, so so think of it this way. If you, in 1 year's time, right, if you're insuring somebody over a year time, there's many more days and many more chances that they will get into an accident, right? So 365 days. If you cut that in half, there's less days for them to get into an accident. So all of a sudden, there's a time decay. That's what we call a time decay. So maybe it's only $1,000 premium or whatever it is. But all of a sudden, it's not, the premium will start going down, right? Because let's say there's only 1 day to go. Well, if you only have 1 day of driving, there's a less chance in 1 day of getting into an accident than there is of 365 days of driving, right? Because you're doing less driving. So as you're getting closer to expiration, right, and everything is the same, if you're getting closer and closer to expiration and everything is the same, you'll see a decay. That's how options work. As you're getting closer and closer and closer to expiration, the time premium, what we call, will start decaying, and those options will lose value. So even if the stock is staying at the same price and nothing happens every day, you will see that there's a time decay and it goes lower and lower and lower. Okay, does that make sense? Hopefully, if somebody says no, let me know, but that's time decay.
Does the time decay make sense to everyone? Let us know in the chat, please. They're all saying yes on Zoom. Zoom's a little faster than YouTube. I'll let you know if anyone's not understanding time decay in YouTube.
No problem.
It seems
all
good
right.
right now.
Awesome. So what else? But what can make it go up? It doesn't necessarily always have to go down because of time decay. Let's say 6 months go by, and let's say at this point it's worth $1,000, right? So to insure for 6 months, it's $1,000 instead of $2,000. But all of a sudden, maybe there's an event that could increase the risk of a total loss to your car. Let's say you're parked, let's say you're parked, I don't know, somewhere close to the ocean, and there's a big hurricane, and it's going to be a, potential catastrophe. We don't know, but cars might, sink, get under the water, under the, salt water. At that point, that car is just going to be total loss. So when they wrote that insurance, they didn't know that was going to happen, right? So that wasn't planned. They didn't know 6 months ahead of time like that there was going to be like some kind of great, hurricane that's going to sweep over and, and that happened in New York, I think, one time, right, Will? Like where there's like a big hurricane and salt water.
Yeah, it wasn't a hurricane. It was Sandy.
Or Sandy.
Which was a hurricane type event. It was a big category 1 storm that was moving up the coast. It was a tropical storm by the time it hit, but it hit at like a full moon tide and really caused a lot of damage to parked vehicles.
Exactly. So let's say 6 months go by, that to insure 6 months, it's $1,000, but all of a sudden the weather forecast says like, hey, something really bad's going to happen. This hurricane's going to hit. Get out. Like any cars parked there, they're gonna suffer. So at that point, you're not going to be able to go and ask for insurance for $1,000 because the risk just went up, right? Because now the insurance companies, everybody, so when that happens, it will cost you more that day to insure, because now some events happening, there's public knowledge about it, that insurance could actually go up. So it doesn't, even though it decays, an event can make that premium go up, even though your car is perfectly fine. But now to insure, it's going to cost you more because there's news information out that the risk of you losing is increased. And that could happen in the options as well. For example, when you have a stock and everything looks fine, all of a sudden there's news that comes out, hey, there's going to be an announcement by the CEO, something's going to happen, or the SEC is going to make an announcement about a company, or there's an earnings that is going to come in out. So there's an uncertainty. And when there's uncertainty, premiums go up, because that means some kind of news can come out that can make the stock go either up or down. But since we don't know that, the premiums in the options in both directions will increase. Okay. So keep that in mind. There's a time decay component, but there's also a time where even though the option isn't decreasing, it could also spike up, even when the stock doesn't move, or even if nothing happened yet, because there's some kind of uncertainty going on that didn't exist prior to that. Hopefully that makes sense to everybody. Yes.
A lot of yeses. We're good to go.
Awesome. All right, let me go to an options chain now. So this is SPY. I'm just going to go to an options chain here. So over here, we talked about on an options chain, this is what you typically see. So this is SPY options chain. Let's look at like some of the things we talked about. I'm going to go to over here. These are different expirations. Remember, we talked about terms. You had 1 year term, 6 months go by, there's only 6 year terms. So options have same thing. They issue a new option, let's say 30 days, but every day you get closer and closer to expiration. So this one I clicked on, this option expires August 28th. See where let me see if I can make this bigger. Let me close this out. So here's August 28th. This one expires. It has 9 trading days to go. Okay. I could go to a different expiration like September 8th. This option, right, that expires September 8th has 15 trading days to go. So those are kind of the terms, right? They have an expiration date. So from today to expiration, that's how the contract works. On this side, you have the calls, call bid, call off, and these are the strikes we'll talk about. This side that we're talking about today are the puts, okay? And these have strike prices. So remember we talked about strike prices. When you have a car worth $25,000 today and you want to insure a catastrophic loss of $20,000, your strike price was $20,000. So these are the strike prices over here. So this is SPY, closed at $337, right? So look, this is a put option for $333. You have the right to sell it at $333. This is the right to sell it at $332. This one is $331. So they have different strike prices, right? Maybe you don't want to insure your car at $20,000. Maybe you want to insure it at $18,000, or maybe you want to insure $15,000. So you're willing to take, if it's worth today $25,000, and if you insure it at $20,000, you're willing to take that $5,000 risk, right? So the first $5,000 you're going to lose. But what if you insure it at $15,000? So you're taking more risk, right? So in case of catastrophic loss, you could sell it to the insurance company for $15,000, but you bought it for $25,000, so you're still risking $10,000 and then insuring the rest. But why would you do that, right? Why would you get insurance for $20,000? I'm sorry, for $15,000 instead of $20,000. So why would somebody do that? Does anybody know? Or why would somebody say, I'll insure $15,000?
Any guesses up there? It costs less, is a guess.
It costs less, exactly, because
pay a lower premium, cheaper.
Exactly. Very good, guys. So that's how money. Exactly. So you see in when we talk about puts, here's the distance from the current price. The current price is $337.76. Here's 336 strike. This is the market. $4.56 bid, $4.60 offer. You go here, 335 strike. The bid is 425, offer 428, 334, 395. So you see, as you're going down in strikes, it gets cheaper and cheaper and cheaper, right? You see the prices, how they're going down. They're going down, 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 as the strikes are going down, 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 right? So that's just like you said with the insurance company. That's how it's working in the put options, right? The premiums are cheaper and cheaper and cheaper as you're going further and further away, because the probabilities, right? The payouts and the probabilities are changing as you're doing that. Let me see another observation. So we talked about the strike prices. We talked about, here we go. What do you think would happen is, here's a put option with, let's say August 19th, right? So August 19th, hold on, I got to move away this Zoom stuff. It's blocking my stuff. So look, August 17th has 2 trading days to go, right? 2 trading days to, I'm sorry, August 19th. I apologize. Today's August 2 trading days to go. Here's a put, the 335 put. It's 50 cents, 51 cents. Okay, 50 cents, 51 cents. The strike is $3.35. That's with 2 days to go. What do you guys think will this put be worth more or less if I go further out in time, if I go to August 22nd? So August 22nd, we'll have another 2 days. So what do you guys think? If it's 50 cents with 2 days to go, will this be more to insure with 4 days to go?
Everyone's pretty smart on this Zoom meeting, D.
Okay.
They're all saying increase.
Okay, so that's very important, right? Just to understand, even though it sounds like this basic, see 335, 4 days to go. Look at that, $1.06, $1.07. So as you go out in time, the premium is higher. As you go out in strikes, the premium is lower. It's good that you guys understand. I don't mean to, but if you don't, you'll be surprised how many people say, I don't get it, so that's good that everybody understands that. let's stop here now, because I don't know at what level everybody is.
D, we did have a question while you're on the options chain.
Yeah.
Christine is asking what the Theo means in between the bid and the ask.
All right, that's a good question. So remember we talked about why would an insurance company sell a premium for $2,000? All right, like why would they do that? Well, obviously they think that if they're selling it for $2,000, it's probably worth it to them, right? Because it's probably worth less. It might be worth $1,500, right? So if it's worth $1,500 and they're selling it for $2,000, right? That means they're selling it for a $500 profit, right? If you're selling something for $2,000 that's worth $1,500, that's a $500 profit. So they think theoretically it's worth $1,500. They figured that out through probability calculation. Now, there's no one right answer to do it, but people use models. So we have different models to help you calculate Theos. That's under here. Before I explain it, let's look at this example. Let me jump back to this. Okay. So they are selling you a premium of $2,000. Let's say that the catastrophic loss is 20,000, right? That the catastrophic loss is 20,000, and they think that one out of 20 people, right? 1 out of 20 people this will happen. They'll have to pay out. Okay. Does everybody follow me? 1 out of 20 people, and they're going to have to pay out $20,000. So what is that insurance policy worth if it's 1 out of 20? What do you guys think?
Guesses, people. Any guesses on that? 1 out of 20. What's it worth?
They're selling it for $2,000. What do they think it's worth? What's their break even per policy? Think of it that way. What's their break even per policy?
Christine says 5%.
Which is what?
Which is what, Christine?
5% of 20,000.
Well, 10% is 2,000, D. So 5% would be
1,000, right? So
there you go. Saud says 1,000. Christine,
right? So on average, they think that it's $1,000. Why? Because if they sell 20 policies, right? They sell 20 policies, they're going to pay out $20,000, which means on average, if you take 20,000 divided by 20 policies, they need at least to collect $1,000 from 20 people to break even. Does that make sense to everybody? If out of 20 people, they're going to pay $20,000, their break even is $1,000 per policy because they need to collect $20,000, right? For those 20 people. So if they're selling each policy for $2,000, that's what they think. If they think theoretically, right, based on their probability, 5%, based on their probability, it's worth $1,000. If they're selling it and for $2,000, that's the market value. That means they're selling it for a pretty good price, right? Now, that doesn't mean if they sell one, they're automatically just gonna, because that one could be, could be the bad one. But that's how they're looking at their probabilities. Does people kind of get that, Will? If not,
let us know, chameleons. Does it make sense to you? Just put it in the chat. Hey, while I'm speaking, if anyone, we have a bunch of people on YouTube, please give us a thumbs up. That's always helpful in everything that goes on in YouTube. And if you haven't subscribed, this is to everyone. Make sure you subscribe to our YouTube channel. You get alerted to any videos that come out, and Dima's always putting out some interesting content. So we do have a morning show you get alerted to, so it's worth subscribing. Sorry, D, for the plug.
Yeah, no problem. So that's basically what a theoretical value is, where they think, what do I think it's worth? Now, obviously, you don't know for sure. You're using kind of historical data to guide you. So if you're looking at, hey, I'm looking at the last 1,000 policies, 1 out of 20 people, this is what happens. So you could kind of, if you're using historicals and you think nothing's changing and the next year will be similar, that's how you price it. So each policy, theoretically, you need to collect $1,000 to break even. So if you're selling it for more than $1,000, you're going to pay out 20 grand, but you received way more, right? So if I sell 20 policies for $2,000 a piece, I collect 40 grand, but I'm going to pay out 20 grand. I still made the difference of $20,000. So when we look at options, how do options get priced? Based on probabilities of something happening, that we call, as professional traders, theoretical values. Okay, so that's a good question. I think it's a little bit more advanced though than I wanted to get into today, because just understanding the put option, and I will get into that more in further webinars. It's a great question, but it's also involves kind of, it's a little bit more advanced. So for that first time, you kind of have to understand a little bit more about the mechanics of options and some probabilities in there. But thank you for the question. It's a great question. Hopefully I made it a little bit easier to understand what that theoretical value is. Let me come back to it. So over here, just to give you an idea though, these theoretical values right here, they're generated by pricing models, option pricing models, and you could select different models. So what do I mean by different models? There's no one right model, right? Like you can't tell an insurance company, well, you should just use 1 year of historical data, or just 2 years of historical data, or 3 years of historical data, or you should just use the last 100 data points, right? So it's really how you take the historical data and you start analyzing it and giving it different assumptions, right? And you could even break it down, like by age groups, or right, because maybe a certain age group could be riskier, if they're just learn how to drive, for instance. So what I'm saying is you could take data and start looking to a theoretical value and using those models and tweaking them to get different theos. So a lot of assumptions go in there, and I'll get more into, but I think that would be too advanced for just today's webinar. Will, any other questions? But thank you for the question.
No, we're good.
Great question. Huh?
We're good. No more questions.
Okay, everybody, I wasn't going to make this one long. I was going to leave it open to a lot of questions. So, if you guys think you're good with the put options.
Well, we'll give it a couple seconds. Anyone have any other questions about the put options?
Okay.
All right, I got one. This is a. Do you want? Someone says I want to close a put option to harvest a profit on the day of expiration. Why would a buyer be willing to buy that option with no time left? And it's an out of the money strike. He's saying, why would anyone buy it if I own it?
Well, you somebody might not buy it, but there are other people that maybe think that there's a small probability that like I said, they might think it's worth 3 cents. You're selling it for a penny. They might do that, or they're closing out too. So what did they say there? He was a buyer. He said, why would somebody buy something that he's selling?
Yeah. If it's way out of the money.
It could be closing, right? Or theoretically, it could be just very low and they're willing to buy it, even though the probability isn't high that they'll make money, but it's very cheap and that they.
Yeah, no, it was always amazing when we were on the floor and closing out and, making markets, and people would come and it would be 6-7 strikes, away, and they'd be paying the same place it was offered at a better price, at a better strike, but they were just getting out of their positions.
Yeah, they could be getting out of their positions or something. It's like you can't know the intent of every single person out there, right? So that's impossible to know why they're doing it. maybe they know something, maybe something's coming up, maybe they're just closing out their risk. It's impossible to know what the intent is of every single player out there because there's lots of them. So you can't, you wouldn't be able even to generalize it. But a lot of times, some people want to close out of their risk. You know, they sold an option for $5. There's maybe a day to go. They could buy it back at a penny and take off the risk, and they'll do that as well. So, you know, there could be lots of different reasons for it.
Very cool. Well, we are getting questions about screeners and more advanced questions. So we get to those every morning. If you don't know, we have a morning show in the morning. That's one of the reasons you want to subscribe to our YouTube channel. You get alerted to those when they go live. They're live shows every morning during the trading week. And with that, we will say goodbye for this evening. Is that correct, Dima?
Yeah, I just wanted to keep it simple today. Let's just talk about the put option. I'm glad, like, you know, I think everybody got it. Again, we're going to be talking on our show some of these questions. We talk about our daily show. So yeah, please join us there. Maybe put some questions there. But yeah, for today, I think that'll be.
That was the put explained by Dimitri Pargamonic. Thanks, D. Great show.
Awesome.
Join us in the morning. Have a safe evening, everyone, and a safe trading day tomorrow. Hopefully we see you tomorrow on the morning show. Have a great night, D.
Thanks, everyone. Thanks,
Bye.
Will.
Bye.
Have a good night. Bye.